Hello everyone, Alex Kim here. The question worth examining isn't whether silver can sustain these levels, but where incremental supply will come from when demand continues at this pace. Mining production is constrained by lead times, capital discipline, and geological realities that don't respond to price signals overnight. Prices will rise, profitability in the sector will expand significantly, and investors who maintained positions through years of underperformance are now seeing that patience validated through fundamentals rather than speculation. Silver is catching up to gold after lagging for roughly 2 years, while gold moved higher on central bank demand and monetary concerns. Platinum has also started following gold's lead, which is consistent with historical precious metals bull markets, where silver tends to outperform gold once the broader trend is established. That outperformance typically comes with higher volatility, but both metals have substantial room to run from current levels. The fact that silver is now leading rather than lagging is a positive confirmation signal for gold. For years, the argument against gold was that silver wasn't confirming the move, which led some to conclude that gold would eventually sell off to restore normal valuation ratios. The alternative thesis was that silver would catch up, and that's exactly what the market is pricing now. Silver has made up significant lost ground, which validates the original monetary thesis rather than contradicting it. This isn't speculation. This is positioning. One aspect that often gets overlooked is that most gold mining companies also produce silver as a byproduct. Many don't report silver as a separate revenue line item, but instead use it to offset operating costs. The higher the silver price, the lower their effective cost structure for extracting gold. For these mining companies, the two largest cost inputs beyond labor are energy and the silver credit they receive. Energy prices are currently as low as they've been in real terms for years. At the same time, they're receiving $95 per ounce for silver that was previously contributing $20 to $25 per ounce to their cash flow. That differential is transforming margin profiles across the sector. Some companies could theoretically be mining gold at zero net cost once silver credits are fully accounted for. Silver that used to offset a fraction of extraction costs is now a primary profit driver. This dynamic might also shift strategic focus within the industry. Companies sitting on silver deposits that weren't economically viable at $25 may now prioritize developing those assets. Silver is approaching price levels that gold traded at in 1999 and 2000 when gold was under $300 per ounce. Silver will likely cross $100 shortly, and depending on how industrial demand and monetary flows evolve, $200 by year end is within the range of possible outcomes based on current trajectory. The central bank behavior underpinning this move is accelerating rather than moderating. Not only are central banks that have been accumulating gold continuing to do so, but participation is widening. Banks that previously held minimal gold reserves are beginning to allocate, which expands the base of structural demand beyond the concentrated buying seen in 2024 and early 2025. Institutional investors are starting to participate, particularly in mining equities, and retail interest is beginning to follow. The difference between 2024-2025 and the current environment is that earlier moves were driven primarily by central bank buying with limited private sector involvement. Now all three segments are active simultaneously, which changes the flow dynamics substantially. Watch the flow, not the headlines. Most equity analysts on Wall Street still don't understand what's happening in the silver market. They view the current rally as unsustainable, potentially a bubble that will reverse, which makes them reluctant to adjust earnings models for mining companies upward. They don't believe current silver prices will hold, so they're not willing to reprice mining stocks to reflect the earnings that these price levels generate. When analysts eventually accept that silver prices are not only sustainable but likely to rise further, they'll be forced to completely revise earnings estimates. Once they recognize how much more these companies will earn compared to previous forecasts, valuations will need to adjust accordingly. Many silver mining stocks are up 4 to 5 times from their levels a year ago, but that needs context. A year ago, these stocks were deeply undervalued relative to underlying asset value and cash flow potential. The moves we've seen are not the end of the repricing, but the beginning. These are operating businesses with tangible earnings, and those earnings are about to expand dramatically. That's what justifies current valuations and creates room for further appreciation. In a classic bubble, prices rise without fundamental support. During the dot-com bubble, many companies had no earnings at all. Investors were speculating on narrative rather than cash flow. The current situation in mining equities is the opposite. These companies have real earnings that are exploding due to higher metal prices, and stock prices have increased significantly, but not nearly as much as earnings growth would justify. These are rational repricings of assets based on objectively higher values, driven by the income they generate from selling the metals they produce. The institutional money that appears to be entering mining stocks now, based on trading volumes and price action in recent sessions, suggests this is not late-cycle retail speculation, but early-stage professional positioning. The 2011 peak marked the end of a large move that began in 2001-2002. Over that decade, gold moved from below $300 to $1,900. Silver moved from roughly $4 to over $45, representing a tenfold increase. Many mining stocks experienced similar or greater appreciation. That early leg of the bull market anticipated much of what eventually materialized in 2009-2011 with quantitative easing and zero interest rate policy. Gold then consolidated sideways for more than a decade and didn't break out of that range until 2024. Silver didn't break out until 2025. Mining stocks, despite tripling or quadrupling from their lows, are only now returning to 2011 highs. Some have exceeded those levels, others haven't quite reached them yet. What's unfolding now appears to be the beginning of a new leg rather than the final stage of an exhausted trend. The current environment resembles 2001-2002 more than 2011. That doesn't mean you're entering at the absolute bottom with gold at $4,800 and silver at $94, but it suggests positioning closer to the beginning of a structural move than the end. Are you seeing the same revaluation pressure in platinum and palladium, or is silver moving on its own supply-demand dynamics at this stage? If you find this breakdown useful, consider subscribing so you can track how these positioning shifts develop. When platinum was trading under $1,000 per ounce, and gold was over $3,000, the ratio implied you could buy 3 ounces of platinum for 1 ounce of gold. Similarly, you could buy over 100 ounces of silver for 1 ounce of gold. Those ratios represented extreme mispricings that created opportunities for rotation. The recommendation at that time was to buy silver and platinum, not because gold was expected to decline, but because those metals were likely to appreciate faster. That thesis played out. The general allocation framework has typically been 2/3 gold, 1/3 silver for monetary preservation. Last year, when silver was extremely cheap relative to gold, that shifted closer to 50-50. Now, with silver having appreciated substantially, the framework is moving back toward 2/3 gold, 1/3 silver. The broader macro backdrop suggests the U.S. economy is approaching a crisis that will be more severe than 2008, because this is not just a financial crisis, but a sovereign debt and currency crisis. Gold and silver are signaling a breakdown in the monetary order with the U.S. dollar at the center of that structure. Central banks are replacing dollars with gold, which reduces demand for U.S. treasuries. Global investors are divesting from U.S. stocks and bonds and reallocating capital domestically rather than financing U.S. twin deficits. The U.S. depends on those capital flows to finance budget and trade deficits and to supply goods that domestic production doesn't cover. That structure is unwinding, and most participants remain unaware, just as they were in the weeks leading up to the 2008 financial crisis. This is not a retail story. The stock market has been strong under multiple administrations, but when measured in ounces of gold rather than dollars, it's extremely weak. The Dow was at 10,000 in 2000 and approached 50,000 recently, but gold was at 260 in 2000 and is now close to $5,000. In real terms, equity markets have underperformed dramatically. Bitcoin provides a useful comparison because it was promoted as digital gold and a hedge against monetary debasement. Last year, Bitcoin went essentially nowhere while gold was up 65% and silver was up over 100%. So far in 2026, the pattern is repeating. Gold and silver are even stronger in January 2026 than they were in January 2025, while Bitcoin remains flat. Bitcoin has no correlation with gold, despite the narrative. It doesn't trade like gold, doesn't function like gold, and doesn't respond to the same macro drivers. Every prior economic crisis, whether the dot-com bubble, long-term capital management, the Asian financial crisis, the 2008 financial crisis, or the COVID pandemic, was met with the same policy response: monetary expansion, interest rate cuts, and fiscal stimulus. The coming crisis will be different because those tools will not only fail to stabilize the situation, but will accelerate the breakdown by further eroding confidence in fiat currencies. The public narrative lags the positioning. Central banks, institutional allocators, and informed participants are already adjusting. Retail participants and mainstream analysts are still interpreting current moves as temporary dislocations rather than structural repricing. That gap between perception and reality creates opportunity for those who understand what's driving the underlying flows. Mining stocks remain undervalued relative to the earnings they're about to generate. Energy costs are low, silver credits are high, and operational leverage to further metal price appreciation is substantial. Wall Street hasn't fully priced in the earnings explosion that's coming because analysts don't yet believe current metal prices are sustainable. When that view shifts, repricing will accelerate. The question isn't whether metals will continue higher, but how long it takes for broader market participants to recognize that the move is structurally supported rather than speculative. Institutions don't chase price, they manage exposure. That's what we're seeing now in the flow data, and it's why this phase of the metals cycle is just beginning rather than ending. What part of the mining stock revaluation do you think the market is still underestimating given the earnings leverage these companies have at current metal prices? Leave your thoughts below, and I'll continue tracking how institutional positioning evolves from here.